If you have been following the news in the fintech space over the last couple of weeks, I think you would know by now that Robinhood has made quite a splash with their recent Gold event. Now, during the event, they actually launched products like Robinhood Strategy, which is basically your own personal investment advisor, as well as things like cash delivery. Now, honestly, I'm not too sure whether or not the long-term adoption for cash delivery will actually work out, because I think it's a novel idea. People might try it once or twice, but I don't see a world where I'm going to get a stranger to deliver my cash to me. But at the same time, they also launched things like Robinhood Cortex, which is your own personal AI trading assistant, helping you to analyze the different setups in the market and to understand some of the trades that are available. And then we have the product that caused the biggest commotion, and that is Robinhood Banking. And I think for many people, this was extremely frustrating, especially if they have been a long-time SoFi shareholder, because it now feels like not only is SoFi moving slowly, but now Robinhood is coming after their slice of the pie. And therefore, in this video, we are trying to help you understand Robinhood's underlying business and to make sense of its valuation today. But I think more importantly, to answer the question whether or not Robinhood really has the potential to disrupt SoFi as a business and outcompete them in becoming the one-stop shop for all financial services. But as always, potential is a dangerous word, so let's dive in. So I think it's important for us to start by looking at some of the metrics that Robinhood's own management actually look at to measure the health of their business. Now, I think beyond that, if you're talking about, the business model of Robinhood, where they actually get their revenue from and their total addressable market, I've addressed these questions in another video, which I'm going to link over here for those of you who haven't actually watched it. So the first key, metric that the management actually look at is this thing called net cumulative funded accounts. Now, this has grown from just over 18 million in the first quarter of 2021 all the way to around 25.6 million accounts today. And so I believe that is what you're seeing with the blue bars over here. Now, of course, it's not, only important for you to have people on your platform, but it's also important that these people interact with the platform. And that is what you're seeing over here with the second metric that they measure, which is, the monthly active users, or MAU. Now, I'll show you the chart for the monthly active users in a little bit, because I'm going to, link that with another point that I will make later on in this video. But in the same chart that you're seeing over here, along with the net cumulative funded accounts, what I've done is I've laid over this thing called the assets under custody, which is represented by the orange line that you see over here. So it's not just the total assets under custody, but assets under custody per account. And this is important because if you just take a look at the account growth, you can see that actually the account growth hasn't been that fast over the last couple of years. Now, they actually grew the net cumulative funded accounts quite quickly in 2021, but beyond that, it has actually been a slow and steady growth, which was actually quite surprising to me. With all this, positive narrative surrounding Robinhood, before I actually deep dived into the numbers, I actually felt like they were growing accounts faster than this. And I think, especially because we were in a pretty strong market over the last 2 years, I actually expect this number to actually come in faster, which is why at the end of the day, the assets under custody help us to understand an important part of their story, because this actually shows me that people are feeling more and more comfortable depositing their assets with Robinhood, and to see that climb steadily since the end of Q4 2022, I think that's a good sign. And I'm sure that is also in part down to the bull market that we have been experiencing over the last 2 years, that even though people might not have put a lot of their money within Robinhood, just by virtue of being in the bull market, their assets will grow. And that is what we're exactly seeing when you track the net deposits, because when they actually track the net deposits, you can actually see that throughout 2023, during the start of the bull market, the net deposits were not growing at a significant pace, but during this time, the assets under custody per account was still growing. And to me, that is down to the function of the bull market that we found ourselves in back in 2023. And we see that continue to accelerate in 2024, also because net deposits have since increased, and I think that is due to their adoption of crypto and at the same time their marketing of Robinhood Gold membership. Now, right now, what I want to do is to take you back to that second metric that we previously glossed over, which is the monthly active users. Now, what you notice over here is that while the total number of funded accounts actually stayed more or less consistent, or at least grew at a more moderate pace over the last couple of years, what you actually see is that the monthly active users as a percentage of overall funded accounts was still increasing. Now, the whole purpose of bringing this to your attention is not to debate, how often people should or should not be using their accounts, because I'm aware of people in the comments actually saying that, you see, Robinhood is a platform that encourages people to gamble and to trade and to touch their platforms often. And if you want to be a good long-term investor, you should not be touching your platform so frequently. So because of that, they are a bad investment, they are a bad company and things like that. Now, I do have a specific answer to this sentiment later on in the video. But, bear with me for a while as I put on my investor hat. So as an investor, I think to me, the most important thing is that when a company brings a product to market, whether or not people are engaging with the product and are using it on a consistent basis. And what we are seeing on Robinhood's platform is that yes, people are actually engaging with the product and using it. And so like I said, let's not try and make this an issue about, trading and investing, because I think the whole issue behind trading and investing isn't even an ethical issue in the first place, because both are legitimate ways for people to interact with the market, and it really doesn't do anyone any good if your analysis of Robinhood is that it is a bad company or an evil company. I think what has done me a world of good is to accept that, all this frustration I feel is due to SoFi, at least in my perception, moving slower compared to Robinhood, and nothing to do with whatever Robinhood is doing, because they are in their full right to build their platform the way that they have built it so far, and people can interact with their platform in whatever way they choose to do so. And so to me, this whole narrative around Robinhood being a platform more for trading and then investing and doesn't help people build good investing habits really has no, real merit. And I'll address this in a little bit, because the fact of the matter still remains that the monthly active users on Robinhood increased from 10.9 million members all the way to 14.9 million members. And I believe that is down to the function of the bull market, as well as their marketing and the number of products that they have rolled out over the last couple of years. But right now, if you take a more zoomed out approach of the entire business, I think what you can see over here is that the percentage of monthly active users actually declined from over 90% just a couple of years ago, all the way down to 40% before where we find ourselves today in the 60% range. Now, the way that, when I look at the history of Robinhood, the way that I make sense of this is basically the transformation of Robinhood's entire business. You see, previously, they were seen as purely a brokerage. So whoever signed up for Robinhood was primarily using them as a brokerage platform. And because of that, people tend to log into their brokerages rather frequently, right? And so because of that, you can actually see a high percentage of monthly active users in comparison to the number of funded accounts. But as Robinhood evolved, as they added more and more products into their ecosystem, what you get is people coming onto Robinhood's platform for things other than investing. And because they don't use Robinhood as their primary brokerage, they might not log in as often, although they continue to keep their assets with Robinhood. And that is why it's important to understand both the monthly active users as well as the number of assets under custody in context of each other, and how they both represent the health of different aspects of the company and perhaps slightly different customer base that the company is going after. So looking ahead, I think what we notice is that, in a bear market and in a bull market, that this monthly active user is hovering between the 40 to 60% range, dependent on the market that we are in. And like I said, we have seen that, in 2022, in a bear market, this tends to trail off. So basically, I do think that if we enter a bear market in the second half of 2025, if the Trump tariff and all this trade war thing really drives us into a bear market, then I won't be surprised to see this 14.9 million number fall back down to the 10 to 11 million dollar, 10 to 11 million member range. And we have to understand how that affects their business and their valuation going forward. So these are the numbers that we know management is paying attention to. But as investors, I think it's also important for us to understand the financials of the company. Now, previously, I have told you that, in the video that I was linking up previously, that Robinhood basically made their revenue from three main sources: transaction-based revenue, interest income, as well as other sources of revenue, where they actually categorize things like their Robinhood subscription service, right, to Robinhood Go. So without getting too technical, I think there are a couple of things here that I want to point out to you. If you take a look at the breakdown of their revenues, which you see over here, you can see that the large majority of this comes from transaction-based revenue. Now, within the transaction-based revenue itself, in 2024 alone, there is a 50% year-over-year increase in terms of options trading revenue and a 364% year-over-year increase in cryptocurrency revenue. Now, personally, if you ask me, I think this seems rather hard to replicate. And the reason for me saying that is that Robinhood did not do anything in particular to drive up these revenues. Yes, Robinhood marketed their platform. Yes, Robinhood made incremental improvements to their platform, but nothing in particular to drive up the revenues in these two sectors. And I think a lot of that is also down to the function of the bull market that we find ourselves in. So to me, I think the reason for this increase has a large part to do with the bull market that we were in, and a smaller part to do with what Robinhood has done to improve their products and services. And so that is the first thing that we need to pay attention to as a Robinhood investor, because we have to understand that, this transaction-based revenue will dry up as we enter a bear market. which will historically happen once every couple of years. So don't go into this investment thinking that this will never happen and all that, right? I'm not trying to be bearish over here. I'm just trying to be as objective as possible. And this is something that we have to keep in mind if we make this an investment in our portfolio. Now, you can say what you want about Vlad, but the numbers here absolutely speak for themselves, right? Vlad has demonstrated an incredible ability to allocate capital. Now, if you are just looking at this on the surface, right, it seems quite straightforward. He cut operating expenses by around 20%, and during the same period of time, over the last 2 years, he grew revenue by 117%. But if you stop here, you actually miss out on where the magic happens. Now, if you take into account their operating expense, he didn't make a cut in every single department. Now, if you take a look at their R&D, you can say that it has been pretty consistent, right? There was an 8% drop between 22 and 23, but that increased 2% between 23 and 2024. So that stayed pretty consistent around the $800 million mark. So this is what allows them to innovate at the pace that they are innovating right now. And I think where you see the biggest cuts is in operations, where he cut expenses by 53% in 2023 and a further 3% in 2024, taking this down from $250 million all the way down to $112 million. Now, on top of this, we also see a significant cut in G&A. This came down from $1.1 billion in 2023 all the way to $450 million in 2024. And so this represented a 61% cut in just 1 year. Now, during this period of time, he reallocated a lot of this capital into driving his marketing efforts. Because of that, marketing spend actually grew by 123% year over year. But before you get overly concerned and say that this is not sustainable, I just want to remind you and point out that they are growing their revenues at 117%, right? So actually, if you calculate this actually still stands within 8 to 10% of overall revenues, which is where they have been historically, right? Which means that they are still growing at a very healthy pace, and they actually still have room to continue to accelerate and push their growth if they choose to do so. So with all this in mind, let's talk about some other considerations, more qualitative aspect of the discussion before deciding whether or not Robinhood makes a good investment. Now, currently, Robinhood is in the midst of a $1 billion share repurchase program, and as of 31st December 2024, they have bought back around $250 million worth of shares, which means that if they continue to grow their profitability as well as buying back all these shares, we should see a significant boost to their earnings per share. Now, the second thing I want to touch on is their cash commitments, because I know people have concerns about their aggressive marketing for some of their products, especially the Robinhood match incentives, whether or not they actually have the cash to be able to make whole on some of these commitments. So if you take a look at this table over here, what this shows you is that as of now, their total cash commitments in the next 2 years stand at around $930 million. However, cash on hand, cash and cash equivalents, they actually have $4.33 billion. Held to maturity investments, they have nearly $400 million worth, and stablecoin of around $361 million. So you can see that Robinhood is actually a very, very well capitalized company. Now, the next thing I want to talk about is their competition in the credit card space. Now, if you take a look at Robinhood Gold Card, right, as of today, they have only issued out around 100,000 cards, despite having a wait list of nearly 1 million people. So to me, I think that shows that management is still being prudent in their execution and not rushing to just get all these credit cards out into the hands of people. And I do think that this is a very wise thing to do, because I think companies can very easily get burnt in the credit card space. And I think this basically, in a sense, justifies how slow SoFi have been moving in this credit card space. And I think SoFi themselves, if I'm not mistaken, I think when I was preparing for next week's video, I actually noticed that they only launched or they issued out close to around 300,000 credit cards. So yes, they are still a little bit ahead of Robinhood, but I think you can't blame them for being slow in this respect, because Robinhood, yes, they do have the demand. They have 1 million people on the wait list, but at the moment, they have only to date issued 100,000 cards, looking to only double that in 2025 to 200,000. So even if SoFi does nothing throughout 2025, they would still have more credit cards out in the market than Robinhood. Now, if you take a look at the credit boxes that Robinhood is working within, of the receivables, around 16% of the people come with a credit score of below 640. 25% of them come from people with a credit score of between 640 and 690, and 60% of their credit card users actually have a credit score of over 690. So to me, this is actually quite a far cry from SoFi, who serves mostly people with a FICO score of 745 and above. And the credit quality of their customer is something that we do need to pay attention to going forward in terms of defaults. Finally, right now, I want to talk about Robinhood Legends. Now, I just have to say over here, like, even as an investor in SoFi, I have to acknowledge that I feel the same frustration as many of you, but to be completely dismissive of Robinhood as a platform because you think that they encourage gambling or trading instead of investing, I think at the end of the day, you are only doing a disservice to yourself, right? So right now, I'm just going to break down the myth that Robinhood encourages gambling and trading, and because of that, they are a bad platform, and to at least perhaps, open your mind to another perspective. Now, I think for me, I'm pretty new to the whole finance space in YouTube, and so because of that, some of you might not understand my framework or how I think about things. Personally, I don't get attached to any one company. I tend to cover SoFi quite regularly because I have a rather large position in them. But at the end of the day, when the data change, I'm willing to change my thesis, right? Because I think that, as the saying goes, I don't care about being right. I care about being rich. And so the only thing I'm attached to is the my account balance, and allocating it in a way that gives me the best chance of good returns in 3 to 5 year time. Right, so by completely dismissing Robinhood as a platform, I think we are not being intellectually honest in our discussion and not being objective in our analysis. Because I can sit here and tell you today that I have absolutely no idea whether or not Robinhood or SoFi is going to become the one-stop shop for financial services. And I think really anything can happen in the next 3 to 5 years. Because if you rewind back just a couple of years ago, I don't think any one of us has predicted or had predicted that Robinhood will outpace SoFi. But that is the situation that we are finding ourselves in today, where Robinhood is releasing products at a faster pace than SoFi. So, a lot of things can happen in the next 3 to 5 years, and anybody say this is definitely going to happen for sure, they are just bullshitting you at this point in time. And I encourage us to look at this company objectively. And the objective fact is that they have grown their revenue at a very fast pace while maintaining an efficient cost structure that allows them to, push a lot of their profits into marketing. And because of that, they're rolling out products at a faster pace than SoFi right now. But personally, I think this is not down to one company being better than another. I think this is two different strategies. I've elaborated a little bit on this in my previous video, which I'm going to link over here. And I hear you, I will do a deeper dive to break down these two companies and compare them in a little bit more detail, right, in the subsequent video. But right now, like I said, I want to debunk this myth that Robinhood is for traders and gamblers, and because of that, they are evil company or a bad platform. Do with this information what you will. I'm not saying that my point of view is correct or you have to take my point of view, because at the end of the day, this is not financial advice. I'm just some dude on the internet telling you my perspective or on some of my investments, right? So to me, if you take a look at, the spike in Robinhood's chart when you're talking about the monthly active users, yes, I think there are a couple of reasons for it. Crypto is one of those reasons. But if I take a look at the timeline of events or products being released, what you notice is that Robinhood Legends was actually released in October of last year. And this is the platform that they told us is designed for traders. And in Vlad's own words, we want Legends to be a platform that, as a trader, you would feel disadvantaged if you are using any other platform. So you can see Robinhood, what they're doing with Robinhood Legends is targeting a group of people that previously, perhaps wouldn't have used their product. And hence, because of that, because they are, entering into a new market, you can actually see this spike in numbers. And so because of that, I don't think we can complain that, these people that they're going after are traders and not investors, or make comments like trading is like gambling. They're not encouraging people to invest for the long term. And because of that, they're a bad company. I think you have to accept that trading is one way, a legitimate way that people can interact with the financial markets. And regardless of what you think about trading, there is a market out there where people use certain platforms for trading, and Robinhood is choosing to serve within that market. And I want to go a step further and argue that if you want to become a one-stop shop financial services platform, then that is a market that you have to serve. So if you ask me as a SoFi investors, the question I have to ask is, where are level 1 options? Because people can make whatever argument that they want. They can tell me that the average SoFi investor doesn't use level 1 option and things like that. But the fact remains is that if your objective is to become a one-stop shop financial services platform, then I am pretty sure that level 1 options is part of that platform, or should be a part of that platform. But at the moment, they're not doing that because I believe that they hold fairly different strategies. Now, you take a look at SoFi with me for a minute. Their approach seemed to be more focused on building the back end of a financial ecosystem to support their products, like with the loan platform business. So in a sense, customers come to them looking for loans. The customers doesn't care and doesn't even realize whether or not the loan comes directly from SoFi or through their loan platform business, right? So there's no user experience in the sense, or the user doesn't feel anything different on SoFi's platform. They just know that they go to SoFi's platform and get a loan. But on the back end, SoFi has actually built up this entire ecosystem behind them where they can actually, put these loans onto the balance sheet of their partners and then just take a fee from them and not take on any risk. So in terms of that, you can actually see how they're running their business, right? They're building the back end of a strong financial ecosystem rather than rolling out new products. But each time that they roll out a new product, it's very incremental to their revenue as well as to their bottom line. Whereas in Robinhood's case, they tend to operate more like a startup. They launch a bit of banking, a bit of investment advisory, a little bit of credit cards. I mean, everything has started, but everything is not fully built out to the fullest extent. But they get their products into the hands of the customers and they iterate their products from there. So the short-term impact to revenue is not always the most obvious like it has been with the spike in monthly active users. It has been two completely different strategies. Both can work and both really depends on execution. I think my concern over here is that as a SoFi investor, that Robinhood is getting their product into the hands of more consumers at a faster pace than SoFi. And so despite, yes, SoFi is innovating in the background, building up their entire financial ecosystem to support their products, if people already develop a relationship with Robinhood, it makes it that much harder for SoFi to gain new customers. And so you can argue or whatever you want about SoFi's product being more fully built out, so it's better than Robinhood's product. But if Robinhood is willing to roll out a product that is 50% built, right, and to iterate along the way, how many more customers can they get before SoFi rolls out their equivalent product that is perhaps 80 to 90% built? And I think that is a very hard question to answer. And that is why my solution would be actually to own both companies if you're comfortable with that. And, how am I going to decide which company to own and how much of each company to own? Then we have to have a better understanding of their valuation. So as we are talking about valuation, I think it's important to tie in all these fundamental issues that we have been talking about throughout this video to understand the valuation. And I think it's important for us to start with the key metric, which is the net cumulative funded accounts. Now, if you take a look at their monthly metrics, that actually stood at around 25.6 million at the end of February. So I don't think it's too much of a stretch that at the end of Q1, this number comes in at around 25.8 million accounts, which stands at an 8% year-over-year increase. Now, if you take a look at Q2 and Q3, I think because of the macro environment that we might find ourselves in, where there are a lot of uncertainties in the market, I would assume that the growth here starts to slow down like we see in 2022. So around 100,000 accounts added each quarter, and then this will basically pick up at the end of the year in Q4 with around 400,000 accounts added. So ending the year at around 26.4 million accounts, right? So in terms of their revenue growth, we are going to assume only a 10% year-over-year growth. Now, why am I using a 10% year-over-year growth? Because it fits their guidance. They are telling us double-digit growth in revenue. Double-digit, like I said, can be 10% and can be 99%. I think I mentioned this in one of my previous videos, right? So let's just say, worst case scenario, 10% year-over-year growth. That assumes a bad macro, people don't use their platform and things like that. But perhaps not as bad as 2022, where there was actually a decline in revenue. Okay, so in terms of net income margin, we have to be aware that basically in Q4 of 2024, this was actually boosted by around $424 million in tax benefits. So without that, I think the fourth quarter EPS would have been 54 cents instead of $1.01. So that means that if you adjust for the tax benefits, the full year earnings per share would have come in at around $1.09 instead of $1.56. So if we take away all this tax benefits, if we consider 2025's revenue, and we assume an operating expenditure of around $2 to $2.1 billion, and this is something that management has specifically guided for during the last earnings call, then that means that net income would come in at around $1.14 billion, right? $1.14 billion. Now, if you assume that there's a 2% dilution, that would put their full year EPS at around $1.24, and this would actually represent a 13% year-over-year growth. In in the worst case scenario. So you need to ask yourself whether or not this is something you can accept, right? Because with all these numbers that we talk about, their revenue would have come in at around $3.4 billion and $1.24 in terms of earnings per share. So that means at the time of making this video, they're trading at $41. That means they're trading at around 12 times forward sales and 33 times forward PE with a PEG ratio of around 1.92, which means that they are actually slightly on the overvalued side and would likely see a multiple contraction, especially if we do enter a poor macro environment. But there's a little caveat over here, right? The PE ratio that we see today of 25 times is considering the tax credit that we were talking about. So if you take that out, their PE is actually closer to 38 times PE. And when you use that to calculate the PEG ratio, then you get a PEG of 2.92 times, which is even more overvalued. And so if we make a slight tweak to the numbers, let's say we consider the fact that in 2024, they grew their revenues by 58% year over year, and let's say they halved that growth rate to 27% year over year, we'll end up with a full year revenue of around $3.7 billion. Now, in terms of OPEX, they have again told us to expect around $2 to $2.1 billion in operating expenses. And so because of that, the full year net income would come in at around $1.647 billion. Now, that gets you close to a full year earnings per share of around $1.78. So if you consider that their earnings per share after you take away the tax credit in 2024 is around $1.09, that will represent a 63% year over year growth, which means at $41, they are trading at around a 10 times price to sales and a 40 times forward PE. However, that's if they get the growth that we have projected out. And that is why I was saying that this company is very narrative driven, right? Robinhood tends to trade like a proxy to the entire market, and the huge swings in valuation reflects that. And so what I would say is that they are priced for perfection. Now, if you do think that we enter an extended period of volatility, then it stands to reason that you would wait before you open a position. However, if you think that recent macro events are just noise and they will sort themselves out in the next quarter or so, and then when we get a pullback after Liberation Day, which you might find, then you might find a chance to open a position, right? I know by the time you watch this, Liberation Day is already over and you would have known what has happened, but I needed to film this in advance because I might be overseas. But I think ultimately, this is down to your own risk tolerance and your assumptions about the macro environment that we find ourselves in. Now, personally, for me, I think SoFi has executed through a poor macro environment. Student loans were taken away, they still grew their revenue, right? Interest rates were high, they still grew their financial services and posted revenue growth. However, when I think about Robinhood, I think the issue that they have, or the issue that I've had with them previously, is the seasonality in terms of their revenue source. And I think I really want to acknowledge that, they have done a lot towards diversifying all these different sources of revenue. But whether or not they can actually scale the other sources of revenue to cushion the impact during the downturn hasn't really been proven yet. So if you add on to that their rich valuation, that is why even though I'm looking to currently open a position in Robinhood for sure, because I think, if you have a more than a 5 to 10 year kind of time horizon, they're definitely going to become one of the bigger players in the financial services space. But despite of all that, I'm not in a hurry to open a position today until I get a confirmation about the market direction. So if we're going down, if I do see an extended period of volatility, then I will take my time to DCA into this position. And with that, I'll see you in the next one.